Malcolm Ethridge is with us. He is, of course, Executive Vice President at CIC Wealth and has $850 million in assets under management. And Malcolm, as we see what is overall a turbulent time, money not knowing whether to commit to stocks or not, what do you make of where one should be putting their wealth in perhaps the medium term, if not short?
Yeah, so the interesting thing about that question, if I could go back really quickly to the conversation you guys were having a moment ago about the yield curve and the yield on the twos and tens being dangerously close, even if it only touched the marker we like to see for a couple of seconds. I would say that I agree that it's only important to us money nerds, us financial professionals. I think that realistically, one of the leading indicators that the average person out there or the average retail investor should be paying more attention to when it comes to that dreaded R word is the retail numbers, and specifically in the lower to mid-tier retail apparel names like a TJ Maxx or a Gap. Those usually tell us more about when we're going to see a recession on the horizon, more than the yield curve inverting for the average person, simply because folks aren't going out there and buying a new t-shirt if their rent is behind or there's a foreclosure notice in the mailbox. And so we're paying attention more to human behavior in this case than we are, historical indicators.
Well, what's the human behavior telling you right now? What are you seeing out there? Is it encouraging? Is it worrying?
Well, it's interesting. We're surprised that the market has come back as much as it has in recent weeks, right? If you look at just the past 2 weeks, the market was down close to 10%. The S&P, I'd say, was down about close to 10%. Up until that point, and suddenly we're roaring back, maybe 3. We're down at this point, depending on where the market closes today. And there's nothing to attribute that to as far as positive news is concerned. The war in Europe is still going on, and we see no signs of that abating anytime soon. And oil prices are still north of $100 a share. And so I will say that this is certainly a faster recovery, if we can call it that, than we had anticipated it would be. But we're also continuing to remind clients to be a little bit suspicious here and focus a little bit more on the long term, not worry so much about what's happening right this moment, because this just proves that we can't predict which way the winds will blow on a daily or weekly basis in these markets. It's really tough. So for folks trying to time it perfectly and, am I in or am I out? This is a very good case study on why it's so tough to make that call.
In the long term, though, are clients asking you about the other bad word on this program, stagflation?
Not so much stagflation as recession. Once that R word gets thrown out there in the news media, like, you and I are having these conversations where we start off talking about the yield curve, which obviously is our indicator for a recession being on the horizon, that R word starts to make people do some really irrational things with their money, like, logging into their 401k and selling out and going to cash, even if they're a decade or more away from retirement, right, as an example. And like those sorts of more irrational behaviors are what we tend to see. But I think the interesting thing, or the more important thing to make sure that we put in focus for retail investors paying attention to this, is that you want to stay, long-term focused, where the interest rates really matter to you are on regular, ordinary things like, purchasing a home or buying a new car, or the interest rate you're going to receive on your savings, when you throw that money into the bank. But just not getting so much caught up in the day-to-day news of, words like stagflation and recession that tend to scare us. Maybe it means we've got to buckle down a little bit more and spend a little bit less near term, right, and keep more cash on hand. And we maybe have to cut one of our 17 streaming services that we're subscribed to. But realistically, in the longer term, it's not going to make that much of a difference in the moment. It's just getting past the noise and the fears of those dreaded words like a recession or even stagflation. That's even scarier if you're a money nerd like I was talking about.
And we love money nerds on this show. Malcolm, talk to us about those that are potentially saving for homes and how fearful they should be of the housing market, if not stagflation and recession and yield curve inversion.
Yeah, so where I was talking about it being a strange time because there's not a ton of positive news out there, but the market is still acting as if we're getting good news. The housing market is definitely a doom and gloom area if we're not careful, right? So we're concerned about the housing market with new home sales falling 2% in January and then another more than 8% in February year over year. And the print for March we haven't seen just yet, but I have to imagine it's pretty close to the same. One of the key reasons for that is that interest rates have no choice but to go up. Interest rates on borrowing for homes, I mean, have no choice but to go up when the Fed is telling us they're committed to aggressively raising rates throughout the course of this year. And so that means that anyone who is already sort of on the bubble or, maybe was cost conscious about how much to spend or not overspending on that mortgage, they might be priced out simply by a 25 basis point or a 50 basis point move in interest rate on a mortgage, on taking out a loan. And that's the difference between the market continuing to rally like it was through the end of last year, or cooling off significantly like we're seeing right now. So, all of us can appreciate the market cooling off and kind of returning to normal a little bit here and there, but none of us wants to see it grind to a screeching halt, which is what I'm more concerned about. The indicators we're seeing right now telling us is a significant chance.
All eyes on indicators. All eyes on your Aggies flag behind you as well. Texas A&M, we like it. Malcolm
Aggie
Ethridge.
pride.
Thank you so much. Come back soon. CIC Wealth.